Hi, everybody. Welcome back to another edition of Chart of the Month. I completely apologize. Looking at the calendar, and with the holidays in November, I completely forgot to do a chart of the month in the month of November. So hopefully we will stay on track going into next year. I've gotten a lot of positive feedback about these videos, so we'll continue to roll with them until you're tired of seeing me on camera. So um, if you've been paying attention to our Friday Financial 4 newsletter, we've been doing a holiday series about spending, money in the holidays, gift giving, financial planning, and those good things. And so, what I thought we would do today is let's check in on those consumers. Um, Consumers catch the headlines because we are a consumer driven economy. And so a lot hinges on what's going on with consumers, whether it's their sentiment, their actual spending habits, assets, debts, things of those nature. A lot of what goes on in the economy is driven by it all. And so I wanted to do this one because right now there's a lot of headlines being thrown around about the consumer. And so I think it's important to take a beat on what the actual data shows us. But ultimately, let's see where the consumer is as of right now. And so, uh, in full disclosure, this chart data is for November, end of November. So we will have to see how the data shakes out for December. But as you can see on the left-hand side, we take a look at the consumer balance sheet. And so the consumer balance sheet on the left-hand side is all of the assets owned by the consumer. And it's separated in their different categories, right? So $197.3 trillion is owned by the consumer. 44% of that are in other financial assets, but you can see 27% in homes, 5% in other tangible assets, 7% in deposits. So deposits would be things like bank deposits, 17% in pension funds. And so when you add that all together, we have a very sizable balance sheet for the consumer. On the right hand side of this, on this chart, you can see the liabilities. And so, in relation to the assets, you can see liabilities are quite small. Um, Mortgages being the biggest chunk of liabilities for the consumer at 67%. We've got student loans and other liabilities at 9, auto loans at 7, revolving debt, which would be credit cards at 6, and then any other revolving debt, which could end up being things like furniture and stuff like that. When you add them all up together, we're sitting at 21 trillion. So yeah, 21 trillion dollars as a number of outstanding debt and liabilities is a very, very large number. But when you compare it to the assets owned by the consumer of 197 trillion, the two numbers are quite on different planets at this point. Now, on the right hand side, the far right hand side, we have two different charts. The top is household debt service ratio. So, obviously, this is very important. If you have a ton of debt and you don't have the cash or the cash flow to service it, that tends to be a really big problem. And so, right now, this chart goes back to 1980, and it is the debt payment as a percentage of disposable personal income. You can see in 1980, it was about 12.4%. In the fourth quarter of 2007, obviously 2007 was right before the financial crisis, we peaked at 15.8%. And currently in the third quarter of 2025, so at the end of November, we're sitting at about 11.3%. And so we're far below where we were at in the peak of just before 0809, and quite a little bit lower than going back to 1980. So again, we want to put the consumer debt ratio in perspective because this tends to get a lot of headlines when this number gets elevated or when this number grows. Secondarily, flows into early delinquencies. And so a this could be a quick view of what's going on in the marketplace to see if there's actual cracks in the foundation of the economy. And so this is a percentage of balance delinquent 30 plus days, right? So that first month of delinquency, this is ones that are trailing into the next section. And you can see between all the asset classes, student loans, since student loan payments have been started up and mandated, is in a very large spike right now. But all the other ones, auto loans, credit cards, mortgages, uh, are growing since 2021 and 2022 when we had interest rates spike and have been grew sharply there, and then obviously student loans. So putting this all in context, the consumer assets are at all-time highs, and the consumer liabilities are within a very reasonable range as a total percentage of assets. Percentage of disposable income going back to the 1980s, again, within a reasonable range. Yes, we are seeing 30-day and plus delinquencies start to grow, but we're seeing them grow in very specific areas like student loans. And so, overall, what I want to do today is not necessarily whether any of this is good or bad. It's that I want to put the headlines in context and show that the consumer overall tends to be sitting on a very healthy balance sheet. But we, again, want to continue to keep our eyes on these 30 plus day delinquencies to make sure that they are under control and contained. But as you can see back, if you're going back to 08, 09, of the delinquency rates, again, those tended to peak and get stressed in that 11 to 15% range. So student loans as an outlier, yes, is growing, but the other areas or the other ranges that we're seeing are still within a reasonable range. So hopefully you found this video helpful to sort of put the consumer finances in perspective. We'll continue to watch these numbers as we get through the holiday season. And we'll check back in with you all for chart of the month in starting next year in 2026. So everyone have a great day, and we'll catch you at the next video.